Call. What do you do? Should the government get involved? What can fix this? We'd like to hear from you. 979-59-MONEY. This is the Real Money Pros.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with AtaraxisPEO.com. That's AtaraxisPEO.com. Ataraxis, elevating businesses for the benefit of all.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
And now, back to the Real Money Pros.
We are back. This is The Real Money Pros, therealmoneypros.com. That's how you find us. Sign up for the newsletter, please. It's free to you. Our advertisers support it. They'll even add some great advice in there that we're trying to get your attention. We want you to become a real expert with your money. You can do it. It is absolutely, you can be a do-it-yourself investor and have great success. It's all about discipline and making sure that you've got a plan. And if somebody doesn't keep you in that plan, or you can't keep yourself into it, you got to pay somebody. Right now, your values in your 401ks are probably the highest that you've ever seen them. And you're thinking, well, I feel great. I'm listening to this program, I'm about ready to switch it off to listen to something more entertaining or whatever it might be. But I'm going to encourage you to continue listening, because now is the time for you to look at your planning. Like, why would you wait until the disaster to then go see a financial advisor and say, what should I change? What should I switch up? I just took some losses. Why wouldn't you do this now? To have somebody take a look at it. So 401ks, by the way, and I didn't mention this in the first hour, I had intended to, which you can hire a financial advisor to be a fiduciary, meaning take control of the 401k trades on your behalf and actually invest that allocation, whether it's an active investment strategy, but nonetheless, it should be a tailored investment strategy that is then maintained. And it's either you're going to do it or you pay somebody else to do it. We talked about expenses earlier on, saying maybe it's worth it. Maybe paying the expense can be worth it, but maybe it's not worth it. And I think we have something linked up to that with a listener email that was sent to us here at therealmoneypros.com.
So use the Ask the Experts feature or use the chat feature. If you use the chat feature, it'll come live. If you're a little hesitant to call the program, as am I, use the chat feature. Visit therealmoneypros.com. So this is coming from Mark, listening out of Virginia, which University of Virginia, big win against Florida State last night. Anyways, I'm a federal employee due to retire soon. I have sat through many financial advisor retirement presentations, and I am starting to hear about fixed indexed annuities. They're saying that the funds in my TSP account, the G fund, will not grow as much as the fixed indexed annuity would, and I would have guaranteed income for life. I would leave 40% in the TSP in the C fund, and the remaining amount, approximately $300,000, in the fixed indexed annuity. Does this make sense? And he listed the fixed index annuities, the actual ones, but he said, does this make sense? Are fixed index annuities legitimate?
Wait, I need to see the notes. You keep talking. I'm looking.
Okay, real quick. One thing we want to talk about now is when we hear about the TSP, the Thrift Savings Plan. Think of it as the equivalent of a 401k for federal employees. Now, within this TSP plan, they have specific funds. They have the C fund, the G fund, the I fund, the S fund, and each of these funds represent an asset class. So the C fund is, think of like the S&P 500. It's U.S. large cap companies.
Corporate fund.
Yep. The I fund is international. The S fund is small cap and mid cap. The G fund is your conservative
It's your government fund.
It's
your treasuries. Just think about that. Very conservative bond rates. And but the TSP in itself, you got to figure it's the largest investment plan, is the lowest expense way to invest qualified money for employees in the nation. It's a good plan. You don't want to just leave the TSP plan willy-nilly. And for equity index annuities, and the reason why I wanted to read the notes is because you said that he mentioned the name of the company. I see it. That is one of the marketed companies that I've heard. And no, I absolutely do not trust equity index annuities in any case. In fact, I'm a financial advisor. I've been one for 25 years. And when I first started in the industry, we all got insurance licensed and we got Series 7 so we could work with stocks, bonds, mutual funds, and things like that. And then we were also fiduciaries with our advisory securities designation. But they all conflict with each other. On the insurance side of it, it was the easiest exam to pass. It doesn't really mean much, but it's usually with the state only, and the state insurance, Department of Insurance, will run what can be sold inside that state, and you're subject to that. So in this case, life insurance, and then also annuity, usually linked together, same person sells them. They're only paid through commissions. The companies that sell these equity index annuities know that they're going to use probably fear to get somebody to go into it, then talk about volatility of markets and the likelihood that somebody's not going to hit their goals. Well, usually they don't even know their goals. The equity index annuities are going to have two key numbers next to them in their quotes. One is, what is it going to index next to? Let's say it's the S&P 500. What is the participation rate? They may say 50% of the S&P 500's performance, but then what is the cap rate? They may say 4% or 5%. We won't pay more than that. But we also won't we won't take for losses, meaning you can't lose, but then you could only gain, and it's going to be, the gains are going to be indexed against something. Now the companies are going to take that real money and they're going to invest it and make more money than you would have. This person right now is probably being sold something with long surrender period, a very, very low likelihood. In fact, I've never once in my career, and I can say this as a fact for myself, I don't know how I'd prove it, but I've never once seen an equity index annuity work out as it was planned and sold to the people who bought it. In fact, I've found that the vast majority of them are disasters, and the very reason why they were sitting in front of me in the first place, because they were trying to figure out what to do with the disaster of it. There are radio programs that's what they're selling. And they'll tell you, oh, the volatility of the stock market, gambling, casino, or whatever it might be. They're going to focus on fear, and that fear is going to sell you a product that you should not be in. I've never seen one as a fiduciary that was the best answer for the client, not once. I've taken several people to task and actually gotten several of them to lose their licenses in our state that we operate in. In fact, I went so far as worked with the Department of Insurance to craft up a new state statute which would change the surrender period and who was eligible to buy them and what kind of disclosures and things like that.
Yeah, it's one of the last.
I don't like them.
The last sentence on here. It's both offer. He's talking about these policies. Both offer a bonus for investing.
Oh yeah.
I think that should be like kind of like a red flag in and of itself. Where if you get a significant bonus for putting your money in one of these insurance contracts or products, a little bit of a red flag. And not to sound redundant here, I mean, Brian, you pretty much well covered it. The issue here, in my opinion, seeing these contracts come across my desk and reviewing them, is that they're sold based on fear, and you're not going to lose money. But that should not be the metric of your decision making when you're investing, especially when you've done such a good job. I mean, I would argue, Mark, if you're listening to this, and I'm going to send you a message directly on this as well, is that you've likely experienced the proper way of investing within your TSP. It sounds like you got some money in the C fund. Like you've seen the benefit of this. And I'd want to know, what's your age? How much money you're going to be distributing now that you're set to retire. The last thing you want to do is have a decision made on, hey, I'm not going to lose any money, and it looks like they're going to give me some guaranteed income for life. I should absolutely do this. You're talking about a lack of liquidity. You're talking about a lot of fees. You're talking about not keeping up with these indexes that they actually link this contract to. I would be extremely hesitant to move forward with this. I would work with a fiduciary advisor to have them look at the whole landscape. Like, I guarantee that whoever's proposing this to you is just looking at this on an island. They're not going to look at, hey, Mark, what's your longevity? What are your goals in retirement? What do you like to do? How much liquidity do you need? How are you going to file for Social Security? How are you going to handle Medicare, covering health insurance before that?
Why are you putting qualified money into a tax-deferred program and not getting any of the benefit of that? And by the way, those equity index annuities, even with non-qualified money, I've never seen one actually pan out right, because you still have to pay ordinary income taxes on the gains. And so not long-term capital gains, no, ordinary. We're talking about qualified money. This is money that is very important to you, and I would say that is one of the worst things that you could put your money into. If you're committed to a 10-year surrender, then you're committed to growth, then why wouldn't you be buying growth investments? This is The Real Money Pros, therealmoneypros.com. You've got a question, bring it to us, therealmoneypros.com, or call us at 979-59-MONEY. We'll be right back.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Did you have a tax strategy going into this year to help maximize your tax savings? I'm Jeremiah Bates with Tree City Advisors of Apollon. We consider key factors like required minimum distributions, Social Security, net unrealized appreciation, 1031 exchanges, and more. Because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively, our favorite, because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
If you have a small business, Staples has your sign.
Banners for my bakery?
Staples has your sign.
Oh, posters for my new pet store.
Floor decals for a pharmacy.
Every day, Staples associates help every kind of small business create bold signs to make big impressions. And now get $10 off custom signs, banners, and posters when you spend $50 or more. This is your sign, so print it big at Staples. Ends 5/28. Visit staplesconnect.com/thisisyoursign for details.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to The Real Money Pros.
We are back. This is The Real Money Pros, therealmoneypros.com. You can find us there. You can call us right now on the program, 979-59-MONEY. That's 979-596-6639. I want to kind of go back into some of the logic of why we use this time-based bucket approach as you create a visual. So you've got three buckets in front of you, one on the left and one in the middle and one on the right. And just think about this. The one on the left is your safest money. This is the stable money that you might need next year. You're going to be paying for a portion of a wedding or college or whatever it might be. That is your conservative money that you would think, if you're thinking risk tolerance and conservative. If you're thinking about money management, we would say stable value. We want that dollar to be worth exactly that amount, hopefully a little bit more, maybe a year later, but it's got to be worth at least that dollar, no risk. When we work with retirees, we tell them you're going to probably have a monthly shortfall between your pensions, your Social Security payments, and what your real expenses are. So you take it from somewhere, and those are your retirement savings. And that shortfall is going to come from that stable bucket, but we're going to want 3 years worth of stability to be allocated within all of your investment mix to make sure that that dollar's there so you're not panicking when the markets are falling, and you're probably not gloating when the markets are great because your income's just stable. Makes you feel good. That means in the middle bucket, we've got to replenish that first bucket with something. We do it on a regular basis. And this is a calculation that if you're using $12,000 a year or $1,000 a month out of your IRAs, and that rate of $12,000 a year needs to be replenished by some amount working hard for you, that if it was generating, let's say 6% for easy numbers in my head, that means you have $200,000 invested in income investments generating that $12,000 a year that you need. The rest of the money goes in the growth bucket. That rest of the money is not going to be touched for 10 years. You don't need it. You may cream the top of it, buy more income to then increase your budget because things do get more expensive over time. But when you buy an equity indexed annuity or any investment product that is going to make a cost for you to leave it early, meaning a surrender charge or a contingent deferred sales charge out of a mutual fund or whatever it might be, you've got a liquidity problem. That liquidity problem also, if you accept that at the end, saying, okay, I get a 10-year surrender, I'm going to stay in this thing, you are treating it like a growth investment. Now let's talk about the person trying to sell you this equity indexed annuity. They're selling you on safety. They're selling you on your lack of risk tolerance for stock market variabilities or the casino that they're selling you on. They're selling you in fear to now treat growth money, long-term money that you admit 10-year surrender is okay, but we're going to invest it as if it's in your stable value account because you can't lose any money. You might gain something. So sometimes it might even act like it's in your income bucket, but it will never act like your growth bucket. When you've already signing the paperwork admitting that this is going to be a long-term investment. Right there is how I will discredit every single equity index annuity sales right there. is because how are you treating the money? From a planning standpoint, this is nonsense. It's nonsensical. It is one of the mistakes that a lot of people will make. And again, we would go back to what is it that caused you to make that investment? And it's going to be based on the fear that was then exploited to get them to sign the paperwork. When you're a senior, you have maybe some extra time inside your state to really look at that. Even after you've signed the paperwork and they've delivered the policy to you, you may have as much as 30 days to really take a good look at that. Go work with a fiduciary. Ask the fiduciary to work in their fiduciary capacity to help you evaluate that and not have a conflict in their advice and turn around and be the one that sells it to you. Go pay them $300. Doesn't matter. If you're going to invest $200,000, wouldn't you like to have the peace of mind to know that it was the right thing? But no, my answer is no. The problem with fixed annuities, equity indexed annuities, they fall in the fixed annuity realm, and they never, because they cannot lose value, the insurance companies will keep them as far as the regulatory issues happen within only a state and not the SEC, because it is not an investment. They are only as good as the claims paying ability of the insurance company. Those are the guarantees they mention. Now, the guarantees, if they can't make them, so you figure they're going to take your money and go do something great with it and make more money for them, but not for you, while you're getting the equity indexed annuity returns, which are virtually zero, and they're going out there to go take risks. What if they fail? They can't even make your pension, your income payments that were part of their guarantees, because their guarantees only as good as them being in business when you need it. So many problems with them.
So many problems. But, Mark, with Mark's question, if he came back and he's like, well, Brian, that's great, but I can't lose money. And that's the beauty of this insurance product, of this indexed annuity, is I will not lose money. I'm retiring now. I can't lose it.
You won't lose money in an SIP insured money market account. You could do an FDIC insured account. You could buy a CD. You could buy a treasury. You're not going to lose money.
You're not going to lose money, and what's the other benefit of
usually
having
tax
those
advantages?
Tax advantages, and you also have
control,
liquidity,
no
and
fees.
Control. You're not locked in. No, so you can completely debunk, just based on the little bit of information that we got from Mark, that no, this probably is not a good idea. Like, do a deep dive, find the other things that are going to move the needle the most, because this fixed index annuity is being pitched to you, and in my opinion, that it's going to be the savior of your retirement. Like, Mark, this is going to be it. You're just going to put this in this annuity, and you're going to be good to go. That's not the case. You're looking at tying up your money. You're looking at high fees. And even if we're talking about the income side of things, we can open up the Pandora's box of the riders, the add-ons to these policies, where you're talking about a whole other type of account that's tied to it that grows, and that's what you can get your income off of. These things can get confusing, and these things can get riddled with jargon really fast. And what it all comes down to is that there's a big incentive for these individuals to sell these policies, number one, and there's a lot of fees with these. I mean, set aside the cap rates and the participation rates that we talked about, so it kind of puts to bed of you're getting equity-like returns. It's like, no, you're getting more like your CD or maybe like a U.S. Treasury return at the end of the day. But again, there's a lot of fees. There's the investment fees that are tied with this. Sometimes these can be 1%, 2%, 3% per year just on fees that are going to eat away at your account balance.
Here's one thing that just rubs me. Our industry, so if you're a Series 65, you're a fiduciary. If you're a CFP, you've got to act as a fiduciary. But you can have other designations like an insurance license, or your Series 7 or 6 allows you to work as a broker, generate a commission. It's a switching of the hats, right? So the switching of the hats is I'm now your planner. I'm working as a fiduciary, but to fill this plan up, we're going to throw a bunch of products your way, and I'm going to sell those to you. So I'm going to switch hats. I'm going to work as a broker. The equity indexed annuity licensed is not a securities regulated product, because it's not considered an investment. So if you were to sit in front of the same person selling you the equity index annuity, let's imagine that they're also a CFP. Ask them one question, which is, okay, let's go into the annuity, but I want you to do it as a fiduciary, as the CFP, meaning no commissions. You're just going to charge me a flat fee. Let's say whatever the dollar amount, $500, and I'll pay you the $500, and you fill this contract. You help me get the contract set up. Would you still do it? And the answer will probably be no. Here's the reason why. Equity index annuities generally the amount of the commission is really close to being the same number of years that are in the surrender period. So if it's a 9-year surrender, then that person is probably getting anywhere from 7 to 11% as far as the commission goes. That's a tremendous incentive when we're talking about a couple $100,000 bucks. A couple $100,000, if you got 10% as a commission on it, it's a $20,000 dog and pony show that you're going to show those people to try to get them to sign it. The incentives are too high. It's conflicting to the advice. I do not like them.
Yeah.
Should I say it again? No. 979-59-MONEY. That's 979-596-6639. I almost just gave out the local number to News Talk KBOI, where we also do a local program on Monday nights. But nonetheless, we're here for you. Call therealmoneypros.com or go to realmoneypros.com. Tell us your story. Like, what's happened? Or has one of these worked out for you? Maybe I need to hear those stories. Maybe that'd be a good thing. Maybe you sell them. Maybe you can tell me where I've got this wrong. Call the program, 979-59-MONEY. But right now, as it sits, I can still say that I've never seen one work out for the person who owned it.
Yeah, it makes sense. I mean, let's imagine that you're someone who's you've been focused solely on your career, meaning, your family, raising kids, being a good spouse, being great in your career, getting the advancement, increasing your income, you're delaying gratification, dumping money into your 401k, your TSP, maybe putting some money in your Roth, paying down debt, and you've finally arrived at the point where you're going to retire, cut the corporate cord, whatever cliche term that you want to use. And now you get to this point in life where you're like, okay, I need to be conservative because I no longer have money coming in. Yeah, I saved all this money, but now it's like this existential nervousness comes in of, well, I cannot screw this up. I don't have the time to recoup. So I completely understand how one can fall into one of these policies when it's all based on you won't lose money, you won't lose money, you won't lose money. But your desired outcome, your success, a lot of times isn't going to work if you're just looking at it through the lens of, I can't lose. Like, if you're playing a game not to lose, you need to be playing it to win. And how you win is you look at everything. You bucketize. You make sure you have enough liquidity on hand. You make sure you're not riddled with fees. You make sure you're taking advantage of growth. You understand your cash flow situation so you have enough replenishment, and understanding how bonds and dividend stocks play into that as well. It's having a thought-out strategy that you logic yourself into based on what's important to you. This is The Real Money Pros. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs, from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then then use tax-free for all of your qualified healthcare expenses. That's why you need Lively, our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
And we're back to the Real Money Pros.
We are back. This is The Real Money Pros, therealmoneypros.com. That's how you find us or call us live here on the program at 979-59-MONEY. If you're thinking about things over the week and you do want to tell us your fraud or scam story or one that you know of, or if you've got a financial question, then please don't hesitate to reach out to us. Go to therealmoneypros.com. Use the Ask the Experts feature right there on the front page of the website. That sends us an email. One of us in the advisory team here is going to answer it. So you're always going to get an answer from a fiduciary. We may ask more questions. We may even ask you if we can read that on the air, and you don't have to agree to it. So it's all free to you. Find us again at therealmoneypros.com. The equity index annuity thing, you can clearly see that I've got some issues with it, mostly because I am the advisor that, I have created and have adhered to a very structured way of behavioral investing and working with my clients to do what's in the best interest of them is generally because I care about them. And I got motivated after seeing the disasters of what's happened with several seniors to the effect that I've got one that is actually, he committed suicide. This is about 20 years ago. And sad situation, but it was scams and fraud. It's horrible. The equity index annuities, sadly, is that I've actually seen as much damage done by some of these people who sell them to households to the point where it was as good as fraud or a scam, in my opinion, because of the way that it was sold to them. In some cases, it was not compliant to the state, so I was able to turn them in and actually get their licenses taken from them. But some of them were just skirting some rules, and they're right along saying things that, boy, it's just it's a little tough. Don't confuse lifelong income with having to transfer it to some company to pay it as a way from you being able to pay it on your own. You will disinherit your family if you die early with an annuitized policy. An annuitized policy is where you have pensionized the payments or made them into a lifelong stream of cash flow that upon your death may stop the payments. And that could occur at any time, maybe a year into it, when you're hoping to get 25 or 30 years worth of income from it. The other part of it is there's a competitive market for buying annuities when you're going to immediately turn it into income. So you would want to price that out to many different companies and hear their bids on which one's going to pay you the most or which one's going to provide the best survivor benefits or whatever it might be. But when you start to compare that to you just managing your own cash, I can't think of it too many situations where they're going to be more efficient. Now, if you're truly concerned about outliving your income because your health is great, then yeah, you might really need to look at that. But I'm going to suggest you're probably not going to do it using an annuity for accumulation, which we would call the accumulation stage of an annuity before you pensionize it.
Yeah, I think if you look at the past 10, 20 years, could you arrive at a well-structured behavioral finance approach where you maintain proper liquidity and that ratio compared to growth? Compare that to anything. Yeah. No, it's just not going to work. You could compare those two. I have a couple clients where, it's like salt in the wound when I brought it up because he asked me that. He's like, well, he was putting, and to be clear, when he met with the advisor, he was switching jobs. He accumulated a pretty decent amount of money inside of his 401k. And this advisor advised him to put this into a fixed index annuity. So obviously the performance was dismal on its own, especially compared to what the market did, because he got into this thing back in 2013. It's 2013 or 2015. So again, But he's just going back. He's like, why would he do this? Like, why would he do this to me? I'm like, well, what was the conversation like? What did you tell him? He's like, well, I told him I was really scared of the market. I didn't want to lose any money. I'm like, well, there you go. And he's like, well, what would you have done different? I said, we would have had probably 4 hours worth of conversation before we even arrived at, okay, here's what I suggest you do, right? I would have given you the education and we would have arrived at the point so we both understood that this money you're not going to touch. And in this case, this was back in 2000, what? Okay, let's say it was 2015, so it was even further out. He's still working. Mm-hmm. So we would have known without a doubt that you have more than 10 years before you're going to touch this money. So then that's going to help us arrive at where we need to place it. And it's certainly not going to be this annuity. Now that we have an interesting dynamic of this where he was participating in one of those riders. One of those income riders. So think of this income rider as almost a separate.
This is a variable annuity then?
Yeah, it's probably, I think it was variable. Yeah.
Yep.
So he's got an income rider on this that's growing at a separate amount. So now we're at the point where if he were to annuitize this, that income rider amount has grown so much where it's like, no, I think we're going to need to keep this because it's just a nice diversification tool. And the fact there's such an age difference. I think he's got about a 15 to 16 age difference with his wife. And if he turns on that income rider, it doesn't get reduced if it pays to his wife. It'll pay for his life and her life, which, looking at it amongst all the other items that he has and the planning that we've done, he wants to get out of it. He's like, I'm done. I want to pay the surrender charge and get out. And I said, well, actually, this is going to be in your best interest where we likely hang on to it because we have other resources.
He's out of the surrender period at this point.
No,
right?
He's not yet. He's not.
No way.
He's not out of it. I'm telling you, he's
not out of it.
He
got it in 2013.
2015.
Okay, 10 years on a variable annuity?
I've seen more than 10 years.
Not on a variable.
I'd have to pull it up.
7 was I don't know. But I do know that a lot of people are looking at that number compared to the surrender charge. And then this guaranteed minimum income benefit thing nearly brought a lot of these insurance companies to their knees simply because they knew that advisors would never let them get to the point where they had to actually guarantee the accounts anyway, because the advisors would, by the time they came out of surrender, they would immediately sell their clients into a new one, then terminating the policy of the one that made big obligations for these income benefits. Well, now that I'm seeing some of these come around, just like Jeremiah was saying, is that sometimes the calculations are there that you got to stick it to these companies and we're going to make them pay for what they had promised to pay. But then we hear about the financial strain. Some of them are buying their annuitants out of the GMIBs. They're saying, we're going to buy you out for $100,000 or some giant number. In a lot of cases, it was absolutely worth it, but that was proof that these companies were concerned about their unfunded liabilities for these income payments. All right, does that mean you should have one? And the answer is no. They've learned how to make them so they're profitable. You won't be. These GMIBs are so expensive that most people are never explained how much that adds to the policy costs. I have seen people that they unknowingly, when they sign the paperwork, were obligating themselves to over 5% per year in internal expenses to be inside these highly loaded up variable annuities with death benefit riders and guaranteed minimum income benefit riders on it. And they're not explained. Then you have the account fees for the sub-accounts. So the mutual funds that are inside of them. A lot of times those are very popular ones. They're managed and they're at very high expenses, like over 1%. And you've got to put all that together with the contract fees. And like, is this worth it for long-term money? If you had a 5% headwind every year and you just wanted to get an S&P 500 like return over 10 years, you have got a 5% headwind against an annualized average of 10%. So you've lost half of your return for those guarantees when you committed the money to long term. That's a shame if he's still in a surrender period like that. And what do? In many cases, you just have to bite the surrender fee and you're going to move out and you're going to take that money and take your losses and take the lesson and get out and go somewhere else where it's going to be more efficient and to your benefit of the long run. But again, how do you get that advice? What is the incentive for the person giving you the advice to bail out and surrender that annuity policy? You've got to question those things.
You do.
And ask the advisor, which is, how do you get paid? What are your incentives here? Because when I first started Tree City Advisors, which is in Boise, Idaho, and then I had another company out in California called MoneyWise. In each case, I was broadcasting, and the most important thing for me was to make sure the listeners knew that I was working as a fiduciary, so the perception was there, meaning I was not going to have a Tree City Insurance Services or Tree City Tax Services because I didn't want to have the conflict, but I was giving up probably 4 times my regular income because I wanted people to know that I was only going to work as a fiduciary, even at my own expense. The reality is I probably should have been selling them the insurance and the taxes because I'm still going to work as a fiduciary no matter what. The SEC says I have to. My insurance companies, meaning our E&O, says I have to. Our compliance department says I have to. I just had to prove it. When you sit in front of a financial advisor, ask them what capacity they're working as. Ask them to only work as a fiduciary and tell them you're happy to pay them an hourly fee in lieu of them receiving any sort of incentive to fill products or put products into your portfolio that you may not need. If you need help, find us at therealmoneypros.com. If you need a great advisor, we know them in your area as well. Find us at therealmoneypros.com and listen next week right here. Same place, same time. Jeremiah, thank you.
Thank you.
Have a great weekend.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors.